Okay, so let us move to the last chapter in financial management, that is working capital management. In simple words, working capital management is money required to run day-to-day operations. You purchase raw material, you will not make the immediate payment, you will get the credit period. You sell it to the customers, you will not get the cash immediately. You will give them the some time to make the payment. Invoice, credit period. Inventory, you have to keep it with you. Cash balance, you have to keep it with you. That is what is called as working capital. So working capital, amount required to maintain for day-to-day operation purpose. We have the concept of gross working capital, which is purely current assets. And net working capital, normally we say net working capital, which is current assets minus current liabilities. Also, we call it as net current assets. We have two methods here. One is total or balance sheet method. Other is cash cost method. I'll come to that. Let me talk about the working capital cycle here a little bit. That one concept you have to understand. Then we can go further. Working capital cycle. So you start with any business with cash, and from the cash you purchase raw materials, and from the raw materials it will become work in progress. It will be worked on, WIP. That is basically it is issued to the production. Then it becomes finished goods. After that it is sold to customer. They become debtors when you sell on credit basis, and when you collect the money back, that is cash back. Now this whole process will not happen immediately. When you purchase raw material, you don't issue immediately. It will be in the go down storage. It will be in stores. And work in progress, the works gets done in factory. And the moment it raw material immediately not become finished goods, like manufacturing car, it might take days. Manufacturing aircraft, ships, it might take months. Construction of roads might take months. Metro, it will take decades for India. So factory. Finished goods once completed will go to warehouse, and debtors, that is customers place, and you get the cash back. This cycle to complete, you see, you will not have cash with you. You need the money. From the money you purchase raw materials, but you need the money for work in progress. Labor will be there, overheads will be there. So the time required to complete the cycle, you need the money to run the day-to-day activities, which is what is working capital management. So essentially, working capital cycle, if they say, it's raw material days plus WIP days plus finished goods days plus debtor days. We can even subtract the creditor days. That's how we get the working capital expressed in days. Uh, well, estimating working capital, we have two methods. One is called as total method, or also called as balance sheet method. The other one is called as cash cost method. What is the thing? Let me tell you. What is total method? Simple, current asset minus current liability. So what does current assets will include? It will include raw materials, it will include WIP, it will include finished goods, and debtors, cash. Current assets minus current liabilities. You will have creditors for raw materials, outstanding salaries, wages, outstanding overheads, current liability, and current assets minus current liability will give you working capital, also called as net current assets. But that is balance sheet method. But in cash cost approach, one small thing we do. What is cash cost approach? To the money, to the extent money actually spent by the company. So in raw material, company has spent the money, no problem. WIP, company has spent the money. But finished goods cost will include the amount of depreciation. Finished goods will include the amount of depreciation, right? But depreciation is non-cash. The company has not put the money out of pocket. Depreciation is non-cash. So that will not be included in current assets. And when it comes to debtors, it will include selling price, includes profits. The profit is not money put in by the company. It is not cost. You will receive the money once you collect realization from debtors. The money is not put in. You don't require that money, right? Why do I need cash? For profit purpose. I need the money to purchase raw material. I need the money to give the money to salary, wages, overheads, to pay rent. I don't need the money for profit purpose. So cash cost approach eliminates depreciation and eliminates profits as far as the valuation is concerned. But in the exam, I would recommend you can do cash cost method, but if they're not specified, you can follow any method. No impact will be there on the liability side. So what are the factors affecting working capital? Nature of the industry, like restaurant business, you get the money immediately. Lawyer's office, you might take some time. Manufacturing companies will definitely take more time. Road construction companies, construction of the road will take months together. Toll collection, you have to you have to connect the road and then you collect the toll. So long time. So nature of industry, size of business, larger the business, larger the requirement. Business cycle, in which part of the business cycle you are in. If you are in initial stages, you need more working capital. Developing company, you're in a growth stage, constant stage. Infosys, very comfortable stage. They don't require much of working capital. Zomato, who's spending lot of money, burning lot of cash, they need more working capital. Operating efficiency, if you're able to sell faster, collect faster, that is basically if you can do the activities faster, you require less working capital. And dividend policy, if you pay more dividend, shortage will be there, you end up in having more working capital. And components of this working capital, what type of questions you can get in exams. One is about estimation of working capital itself, current assets, current liability, or to estimate. I'll discuss problem with that. Then inventory management, we have like EOQ determination, various levels of inventory, maximum level, reorder level, average level. Those questions can come, but I'm not solving those questions. But those questions can also come. It's part of costing, material chapter, same thing will come. So please make sure before you go to FM exam, you revise the costing concept on inventory management, EOQ, levels of inventory. I'm not solving problem for the shortage of time, but keep that also in mind. That also can come in the FM paper. Receivable management, basically they will ask you to evaluate credit policy. I mean, should the 30 days be selected, 60 days be selected? That problem I will do. And you also have something called as factoring concept. That I will not be able to cover, but just if possible, glance through that. Now, cash or treasury management is basically cash budget preparation, opening balance, receipts, payment, closing balance, and this closing becomes opening for next month, next year, and so on. So this is purely budget preparation, no formulas as such. So I will focus on solving problem on working capital overall and problem on receivable management, which is frequently asked in examination. Before go to the problem, I would like to discuss one small point, that is uh, how this various costing should be calculated before we do a working capital estimation. Typical cost sheet, I'll just prepare. So you will have not like your costing, but required for our working capital purpose. For that, I'm giving you this format. We'll start with material consumed. Then for this we will add direct labor, and that expense also you can add. This will give you prime cost. I will add factory overheads. This will give me factory cost, or also called as works cost. Then I will add admin expense, or for the works cost I'll add this WAP, opening WAP. I will add, I'll subtract closing WAP. I get cost of production. Then I add opening finished goods minus closing finished goods. I get cost of goods sold. Then I add admin expense. I add selling and distribution overheads. What I get is cost of sales. Now, how are we going to make use of it? Prime cost we are going to use for, material used, I'm going to use for valuation of raw materials. They will tell you raw material kept for 3 months consumption. I'll do it based on material consumed. Prime cost, that is material and labor, and that overheads also I can say, that will be, or works cost, I'm going to use it for valuation of WIP. And remember, if opening WIP, closing WIP both are equal, usually happens in FM, then works cost and cost of production will be same. If opening WIP, closing WIP both are equal. Then for the purpose of valuation of finished goods, I will take this cost of goods sold. This one is for valuation of finished goods. If it is a cash cost approach, I don't take depreciation. And if I'm doing valuation of debtors, I'll take sales. Valuation of debtors, I will take sales. But if it is under cash cost approach, cost of sales will be used for valuation of debtors. And if opening finished goods, closing finished goods both are same, then cost of production and cost of goods sold will both be same. And sometimes they might give you gross profit. So sales minus gross profit. Sometimes we may go by that route also. That will also give you cost of goods sold. Sales minus gross profit will give you cost of goods sold. So you have to keep this in mind while solving or while estimating working capital, overall valuation of working capital, overall estimation of working capital. You can write down this. If you have any doubts, you can get it clarified. Is it done? Any doubts? Okay, done. Good. Let's take up a problem based on this. Come to this problem. PK Limited, a manufacturing company, provides the following information: sales, raw material consumed, labor paid, manufacturing overhead, including depreciation for the year 3,60,000, administrative and selling overhead, additional information, receivables are allowed 3 months credit, raw material supplied 3 months credit, lag in payment of labor 1 month, manufacturing overheads are paid 1 month in arrear, so 1 month later. Admin and selling overhead is paid 1 month in advance. Oh, prepaid expense. Inventory holding period of raw material and finished goods are 3 months. Work in progress nil. PK Limited sells goods at cost plus 33 1 by 3. Cash balance 3 lakh. Safety margin 10%. You're required to compute working capital requirement on cash cost basis. The question is very straightforward. Straight away, cash cost basis. What is the implication? In valuing finished goods, we don't take depreciation. In valuing debtors, we don't take profit. We don't take depreciation. Read the problem once more. Okay. Let's do the working note first. For the cost sheet I told you, then we will go for the working capital estimation. So working notes for various cost. So let's start with material consumed for the full year, 27 lakh. Labor paid 21 lakh 60,000. Factory overheads, manufacturing overheads 32 lakh 40,000. Manufacturing overheads 32 lakh 40,000. But this includes depreciation. We follow cash cost approach, so we should eliminate depreciation. Minus depreciation 3 lakh 60. So you get 28 lakh 80,000. If it is balance sheet approach, if it is total approach, I'm not going to subtract. And what is the logic behind subtracting depreciation? These are the money required for running the business. Depreciation, you don't require any money. It's non-cash. So we're eliminating it. So this will give you works cost. Since we don't have any information on WAP, WAP is nil. So this is also equal to cost of production. And because there is no difference between opening finished goods, closing finished goods, we assume both are equal. This also you can say cost of goods sold. This is cash cost approach. Okay, these are all cash works cost. These are all on cash cost basis. Works cost, no WAP, so it is cost of production. And opening finished goods, closing finished goods, we usually assume it as equal. So it is equal to cost of goods sold also. Cash cost, everything cash cost. 77,40,000. Admin overhead, selling overheads, 10,80,000. Admin and selling overheads, 10,80,000. So you get cost of sales, 88,20,000. Okay, this is cash cost approach. I'll just do one thing. I will also prepare balance sheet approach or total approach just for reference purpose. Only for discussion purpose. If they ask you balance sheet approach, what you would have done? Metal consumed would have taken 27 lakh only. Labor you would have taken 21 lakh 60,000 only. But manufacturing overhead you would have taken full 32 lakh 40,000. So total 81 lakh plus 10 lakh 80. 91 lakh 80,000. Okay. So metal consumed will be used for what purpose? Metal consumed will be used for raw material valuation. Closing stock of raw material, inventory raw material. This works cost will be used for uh, valuation of, or this cost of production or cost of goods sold will be used for valuation of finished goods. And cost of sales is used for valuation of debtors. And for a balance sheet approach, we don't use 11,80,000. We will use sales. For balance sheet approach, we will use sales. Sales is how much? 108 lakh, I think. 108 lakh. So debtors is what I would have used if it is balance sheet approach. So for cash cost approach, I will be using this number. For total approach, balance sheet approach, I'll be using this number. Okay. Now, I would like to show you one more method, one more alternative. Sometimes instead also calculate like that, alternative. We have one more information. What is the one more information? We have information on this. PK Limited sells goods at cost plus 33 1 by 3 means one third. One third on cost. And one third on cost, Again, convert it to sales. That is 1/3 on cost is 1/4 on sales. Sorry, this one is added. So 1/3 on cost becomes 1/4 on sales. So we have sales information. I hope you know how to convert on cost into on sales. On cost to sales means that one is added. So 1/3 became 1/4. From on sales to on cost, 1/4, I have to subtract 1. So you add 1, you move from cost to sales. You subtract 1, you move from sales to cost. Basically, you're adding the numerator to the denominator, or you're subtracting numerator from the denominator. So we have sales, 108 lakh, and we have gross profit, 1/4 on sales. That also give you cost of goods sold. So cost of goods sold or cost of production, you can call anything because finished goods opening closing both are equal. Cost of goods sold is equal to cost of production is sales is how much? 108 lakh minus gross profit 1/4 on 108 10 lakh 108 lakh. How much is that? 27 lakh. So cost of production 108 lakh minus 27 lakh, I will get 81 lakh. Which is what is perfectly matching, you can see, with this approach. But in this method, what we are following? Cash cost approach. So what adjustment should we do for 81 lakh? Can you tell me? Sales minus gross profit we have calculated. But I would like to do one adjustments for this, for me to get the cash cost. What is that? This includes depreciation. So from this cost of production, if I want cash cost approach, I should eliminate depreciation. So cost of goods sold or cost of production, cash cost is you have to eliminate depreciation. So from 81 lakh, you subtract depreciation of 3,60,000, you get 28 lakh 80,000. Sorry, 77 lakh 40,000, which is what perfectly matching with this answer. And then of course, you can add admin and selling, you get cost of sales, same process you follow it. Okay, hope this is done. I will come to next one. I mean, working capital estimation. Estimation of working capital. So we will have current assets. Later I'll come to current liability. And then we can have working capital as the difference. Current assets, raw material, inventory. Inventory for raw material. Raw material, closing stock. And what they told? Raw material stock, holding period is 3 months. Whatever I consumed annually, 3 months proportionate, I will hold it with me throughout the year at any point during the year. So what is my annual consumption? working note and all, we have used material annual consumption 27 lakh, and 27 lakh is for how many months? Full year, 12 months. So 27 lakh is for full year, 12 months. How much for 3 months, our holding period? 6,75,000. WIP they said 0. So let's come to finished goods. Finished goods stock. We are following cash cost approach. So what number we should use? We will use 77 lakh 40,000. If it is a balance sheet approach, what number I would have used? I would have used 81 lakh. Keep that in mind. I will use 77 lakh 40,000. 77 lakh 40,000 is for full year, for 12 months. And how many months finished goods will keep it in our stock? Finished goods also 3 months. So this also 3 by 12. 19 lakh 35,000. Okay, let's come to then debtors. Cash cost approach. So I will take debtors. This number, which number? 88 lakh 20,000 as the basis. If it is balance sheet approach, I would have taken sales 10 lakh 108 lakhs. Remember that. 88 lakh 20,000. How long you are giving the time to your customer? Receivables are allowed 3 months. So this month is also 3 months. And sometimes they'll give you information on cash sales also. They might tell you 20% are sold for cash basis. If they're given like that, what should I do? This number 88 lakh 20, I should multiply it by 80%. I want only credit sales. So this also 3 months. 88 lakh 20 into 3 by 12. 22 lakh 5,000. And if it was balance sheet approach, I would have taken sales 108 lakhs into 3 by 12, not cost of production. Okay, would have taken sales directly if it is balance sheet approach. Any other assets? Cash balance, they said 3 lakh. Cash balance 3 lakh. Okay. Any other assets? What do you think? We have prepaid expense. Yes. Admin and selling overhead is paid 1 month in advance. Prepaid expense. So admin and selling expense prepaid. Annual expenditure is 10 lakh 80,000 and 1 month earlier. So 10 lakh 80,000 is for full year. How much for 1 month? Into 1 by 12. 90,000. So this will give you the current assets total. Okay. So you get 52 lakh 5,000. Current assets total. Let's come to current liability. Creditor for raw material, raw material supplied 3 months credit. Oh, this also 3 months. Our raw material consumed is 27 lakh into 3 by 12. 6,75,000. This is one confusion some people have it. This also based on 27 lakh raw material stock. This also based on raw materials 27 lakh rate of raw material. Both are raw material. But one is raw material consumed, the other is raw material purchased. Raw material stock is based on raw material consumed. Creator for raw material is based on raw material purchased. But most of the problems both are equal because purchases and consumption are equal. For the reason opening stock, closing stock of raw material we assume equal. Therefore, purchase equal to consumption. In this question, we have no information regarding purchase. Yes, that is one. But more importantly, opening stock, closing stock, both will be equal. So for this reason, purchases and consumption both will be equal. But in some problems, especially they will tell you in a newly formed company, what will be their opening stock? They will not have their opening stock, right? So what will be your raw material purchase during the year? It will be 27 lakh. What is raw material consumed plus what is the closing stock? You should add that also. Get my point? Raw material consumed during the year plus closing stock. That is my purchases. Of that, whatever 3 by 12, I'll get the creditors. And some people get confused. They'll use credit period for raw material for credit period. Just be aware of the differentiation. Okay. Let me come to then uh, lag in payment of wages, outstanding wages payable. You can say wages payable. Wages payable 1 month lag, so 1 month outstanding. So labor we have 21 lakh 60,000. 21 lakh 60,000 and 1 month outstanding. So 1 by 12. 1 lakh 80,000. Then lag in payment of manufacturing overheads, outstanding manufacturing overheads. What is annual expenses? 28 lakh 80,000, right? Cash cost 28 lakh 80,000 and lag is 1 month, 1 month arrear, 1 month late. So 28 lakh 80,000 into 1 by 12. 2 lakh 40,000. So total 10 lakh 95. Okay. Just answer me this one thing. We are following on cash cost approach. So I did 1 by 12 into 28 lakh 80,000 cash cost. 1 by 12 into 28 lakh 80,000. This number I took. Cash cost 1 by 12 into 28 lakh 80,000. Now can you please tell me if I followed balance sheet approach, on what number I would have calculated if I followed balance sheet approach to calculate the outstanding manufacturing overheads? Amazingly, it is not 32 lakh 40,000. On depreciation, you can't have outstanding. Even in balance sheet approach, the difference comes only in valuation of finished goods, valuation of debtors. No other place. Liability will not change. Googly, halwa in examination. Even in balance sheet approach, you still will be calculating on 28 lakh 80,000 because you can't have outstanding depreciation. Okay, very simple point, but very common mistake that people go through, aware of it. Okay, so working capital, current assets minus current liability, 52 lakh 5,000 minus 10 lakh 95,000, 41 lakh 10,000. Okay, they also set some safety margin because we don't want to have exact amount. For safety purpose, we'll have a little bit more safety margin 10%. So you add safety margin 10%, 10% on 41 lakh 10,000. So 4 lakh 11,000, and this will give you estimated working capital. Forty-five lakh 21,000. Okay, so it is done. Any doubts? Okay, let me move further. This crate policy, let me discuss the theoretical aspects, then I'll go for a problem. Receivable management, evaluation of crate policy. Typically, you will come across this problem. You also have inventory management, as I told you earlier, like calculation of EOQ levels. Please make sure you refer your costing material before you go to FM exams. Receivable management. Typically, you will have a problem like this. Should I give credit or not? Is the question. Obviously, you will say, credit, don't give. Why? Why you wait? You collect immediately. It is ideal, but not practical. Given a choice, how many hours you want to read before you go to exams? Given a choice, we don't want to read. We just want marks. Given a choice, but the choice is not there. It is ideal, but not practical. Given a choice, you want to sleep throughout the day also. Given a choice. Anyway, so coming back. So receivable management, when you feel like I want everything for cash purpose. But if you keep everything for cash purpose, your sales will not grow. Your sales will not grow means you can't make more profit. And that is why you have to give more time. You have to have a credit policy. But problem is also there. If you give more time, more bad debts will happen and more opportunity cost will be there. That is what we are going to evaluate. So what will happen? We will do in a columnar basis. Alternative 1, alternative 2, like that. 30 days, 60 days, 90 days. 30, 60, 90. For somebody else, it's different. 30 ml, 60 ml, 90 ml. For us, it is credit period. 30 days, 45 days, 60 days, like that. So we are going to do cost benefit analysis. What is the benefit that we get? And what is the cost that we get? And net benefit, if I say. Net benefit. Typical benefit what I get is sales, increase in sales. But when sales increases, expense also increase. When sales increase, expense also increase. So what is that called as? Variable cost, right? So directly I can do a benefit, incremental profit, or I'll say profit on sales. How can I calculate directly? I'm going to do sales multiplied by GP percentage or contribution, or I'll say PV ratio, sales minus variable cost. Because when sales increase, variable cost also increasing. Effectively, my gross profit increase, my contribution increases. Sometimes they'll use the word GP ratio, sometimes they'll use the word PV ratio, profit volume ratio. So sales into PV ratio, I'll get it. And this is before tax. If you want after tax, you can multiply it by 1 minus T. If information on tax is there, you multiply it by 1 minus T. This will give you benefit, increase in profit. Alternative 1, what is the profit? Alternative 2, what is the profit, and so on. And second, cost, obviously bad debts. This I'll just call it as 1. This I'll call it as 2. Bad debts, when you have more sales, you will have more bad debts as a percentage of bad debts. Sometimes it might be fixed, sometimes they'll give you percentage. So bad debts you're going to calculate as sales into bad debts percentage. And here also, if tax information is there, you multiply it by 1 minus T. If tax information is there. And most importantly, this one, my dear friends, very, very important. Many people do this mistake. This third one, or the second cost here, opportunity cost on debtors. Discount allowed, yeah, bad debts, discount, everything I'll take it together. Discount allowed, bad debts, I'll take it together. But usually they'll not give you a discount separately. Okay, this is the most important one. I see many people getting confused, doing mistake in this one, opportunity cost. Okay, now you tell me. Instead of 30 days, if you give them 60 days, you'll receive the same money only. You tell him, pay me after 30 days. He'll pay you 1 lakh. Or you tell him, pay me after 60 days. He will pay you 1 lakh only. So have you lost anything? Yes, for those 30 days, you lost opportunity of investing those money, right? Had you invested that money elsewhere for that 30 extra days, you would have generated money. Opportunity cost, you understand? Similarly, had you taken loan, bank overdraft, short-term loan, cash credit, had you received 1 month earlier, you would have settled your liability, you could have saved interest. Now you have to pay interest because of the delay. That is opportunity cost on debtors. How we are going to calculate debtors? This is very important calculation. This is debtors multiplied by cost of capital, opportunity cost of capital percentage. Time value of money, absolutely right. This is time value of money only. What I am telling you, opportunity cost is time value of money. The cost of opportunity, what we are telling, is time value of money. Debtors into cost of capital. This is the loss in money because of the delay. And one small point. Now, how do you calculate the debtors amount? How do you calculate debtors amount? Sales multiplied by whatever credit period, right? Debtors is calculated by sales, annual sales multiplied by credit period divided by 365 or 360 as the case may be. And remember, this is what credit sales also. You multiplied by credit sales if you take out cash sales part. This is what we follow for balance sheet approach. If it is cash cost approach, how the debtors is valued? Debtors, we don't value on sales, we value at cost of goods sold, remember? We don't take profit element, we don't take depreciation. So if it is cash cost approach, directly I will write it as annual cost of sales, that is basically sales minus gross profit into credit period divided by 365. And then just like the previous one, you multiply it by cost of capital percentage. This is what I'm going to follow for cash cost approach. Annual cost of sales into credit by 365. What will I get this when I do this? Annual sales into credit by 365. Basically, this is cost portion of debtors. In the debtors, if I take out the profit element, I get cost portion of debtors. Then into multiplied by cost of capital, that is the opportunity cost. Then I am going to calculate net benefit. I don't have the space at the bottom. I'll write at the top. Net benefit is going to be profit on sale, first one, minus second, which is bad debts, and minus third, which is this opportunity cost, that will give you net benefits. And we choose whichever is higher. Whichever is higher. Whichever is higher. We can also express in percentage terms. This is in rupee terms, net benefit. We can also express it in percentage terms. But if you are doing in percentage terms, you should do only 1 minus 2. In the sense, profit on sales minus bad debts, that is net benefit, divided by investment, means debtors amount. That you compare with the required rate of return. This is like IRR, compare with cost of capital. If IRR is more than cost of capital, we accept. But I don't recommend to go that method, just be aware of it. We can also go by IRR method, percentage method. But I usually don't recommend. Institute also very rarely uses. So you don't worry about that. You follow this net benefit in rupee method, what we have written now. So we'll apply it in this problem. If you have any doubts, you can ask. I know time is getting done, but I told you today I'll be extending 5 few minutes. Tomorrow we will be leaving early. So I will compensate. Okay. So let's go for problem. MN Limited has a current turnover of 30 lakh per annum. Cost of sales is 80% of turnover, which means 20% PV ratio, you can say profit volume ratio. Bad debts are 2% of turnover. Cost of sales included 70% variable cost and 30% fixed cost. While the company's required rate of return is 15%, currently allows 15 days credit to its customer, but is considering increasing it to 45 days in order to increase turnover. Of course, if you give more time, more customer will come. It has been estimated that this change in policy will increase the turnover by 20%, while the bad debts will increase by 1%. It is not expected that the policy will result in increase in fixed cost, and the creditors and stock will be unchanged. Should MN Limited introduce proposed policy, assume 360 days a year. So when a proposal comes, what you should do? You should evaluate like this. So the format we discussed now, let us solve it. What is our existing policy? Currently is to allow 15 days, and we have uh, increasing it to 45 days. I will have one column for 15 days, one column for 45 days. Sometime institute solve by only one column. They say incremental sales, incremental cost, incremental bad debts, but I don't recommend that method. You do 15 days separately, 45 days separately, then let's see whichever is highest profit, that is our incremental benefit. Okay, so evaluation, one alternative we have 15 days, other alternative we have 45 days. So we are going to calculate benefit, which is contribution basically. Then we are going to calculate cost. Two types of cost we have, and then we are going to calculate net benefit. Okay, let's do some working note first because they have given current sales and new sales and all. Okay, so let's take up crate sales. Existing crate sale turnover of 30 lakhs. So present sales 30 lakhs, but they're telling cost of sales 80%, bad debts variable. Oh, everything is credit sales only, nothing is cash sales, right? Cost of sales 80%, cost of sales includes 70% variable. Okay, I think everything is straightforward. There is nothing as such for cash sales. Okay, no problem. So I'll just do a quick working note for our reference. So for 15 days, what is the sales given? 30 lakhs, which is made of the set cost of sales. How much percentage? 80%. So 80% of 30 lakh means 24 lakh. So profit is remaining 6 lakh. But out of 24 lakh also one more information is given. 70% is variable cost. So 70% is variable cost and 30% is fixed cost. So 70% of 24 lakh, 16 lakh 80,000, and fixed cost 7 lakh 20,000. You can do the same thing for this 45 days also. Same thing. Sales increased by 20%, right? So 20% increase. So 20% of 30 lakhs means 6 lakhs. So sales becomes 36 lakh. Okay. Now, can you tell me what will be the cost of sales here? Cost of sale, profit. This will be divided into two parts. That is variable cost, fixed cost. Can you tell me how much is the cost of sales in this case? It is not 28 lakh 80,000. It is not 36 lakh into 80% because this variable cost will increase. Fixed cost will not increase, my dear friends. Let me show you that calculation part. You can't simply take the same percentage. The percentage will not remain same. That is the catch here. So here we have 16 lakh 80,000. Variable cost will increase by how much? 20%. 20% of 16 lakh 80,000. 3 lakh 36. So plus 16 lakh 80. 20 lakh 60,000. Variable cost will increase. Okay. Now, what about fixed costs? What do you think about fixed cost? Fixed cost will not increase. It will remain same. That is the catch. It will remain same as 7 lakh 20,000. Therefore, what is the cost of sales? You have to come like this: 20 lakh 16,000 plus 7 lakh 20,000. Cost of sale 27 lakh. Twenty-seven lakh 36,000. Okay. Profit you can compute balancing figure: 36 lakh minus 27 lakh 36,000. 8 lakh 64,000. Balancing figure. Okay. So what is going to be our benefits or profit if I calculate? The profits in 15 days is, 15 days alternative, 6 lakh. In 45 days alternative, I get 8 lakh 64,000. You can also write one more column, incremental basis, incremental profit, 2 lakh 64,000 also you can tell. Difference, incremental, 2 lakh 64,000. Because sometimes institute prepares only one column, but that's okay. You can even ignore fixed cost. You can simply take contribution directly. Why I can take contribution in the two columns? How can I ignore fixed cost? Fixed cost will be same in both the cases, right? Even if I ignore, difference will not be there. So some people write profit here and some people write contribution. Some people also write contribution directly. That is also fine. You'll get the same answer. Okay, I'll just show you quickly how you get contribution also similarly. What is the contribution now? Existing. Sales is 30 lakh minus variable cost 16 lakh 80,000. 30 lakhs minus 16 lakh 80,000. 13 lakh 20,000, right? 13 lakh 20,000. And your sales increase by 20%. Variable cost increase by 20%. Contribution also will increase by 20%. So you see 20% means what increase? 13 lakh 20 plus 20% means you get 2 lakh 64,000. If I add, you get 15 lakh 84. And you get difference as 2 lakh 64,000. So some people also follow this method, contribution method. You can also follow it. But anyway, I'm writing profit method. For me, that is more comfortable. If fixed cost information is not there, you can go with contribution. Same answer will come. Okay. Now let's come to the cost. That is, we have two types of cost. That is, this is benefit one. We have bad debts and opportunity cost. On debtors. Okay, bad debts. What about bad debts? 2% of turnover. So 30 lakh into 2%, 60,000, I think. And here it is increased by 1%. When I say bad debt increased by 1%, you should do 1% plus 2%, okay? Don't increase this 60,000 by 1%. The 2% bad debt becomes 3% of sales. Sales is 36 lakh. 36 lakh multiplied by 3%. This 2% became 3%. 36 lakh into 3%, 1 lakh 8,000. Difference column, I don't want to touch it. Opportunity cost on debtors. Let me read the formula first. Opportunity cost on debtors. We will follow cash cost approach. They have not specified anything. Let's follow cash cost approach. In the exam, you can also follow balance sheet approach. I'll go for cash cost approach. So formula is annual cost multiplied by credit period divided by 360 days, they said. Divide by 360 days multiplied by cost of capital, whatever the percentage, opportunity cost. Annual cost, we have the working notes. Cost of sales 24 lakh into credit period 15 days by 360 multiplied by cost of capital percentage. What is opportunity cost? Required rate of return 15%. 15,000. Similarly here, annual cost is 27 lakh 36,000. 27 lakh 36,000 into 45 by 360 into 15%. 51,300. So net benefits is profit 6 lakh minus bad debts 60,000 minus net benefit 50, profit 8 lakh 64 minus 1 lakh 8 minus 51,300. As I told you, you can also do with contribution. Number will be slightly different, but difference incremental profit will remain same. You can also go by contribution basis. So 6 lakh minus 60,000 minus 15,000, 5 lakh 25, 8 lakh 64,000 minus 1 lakh 8,000 minus 51,300, 7 lakh 4,700. So if I go with a new thing, what is my incremental benefit? Incremental net benefit. 1,79,700. So what we should say? Since there is incremental benefit, or if I go for 45 days, my benefit is increasing. We recommend credit policy of 45 days. So we can say recommended policy 45 days. Incremental net benefit. Incremental net benefit. This net benefit increase. Increase in net benefit. You can say increase also. Increase in net benefit. Okay. I hope this portion is done. So this will take care of our working capital management. I hope to touch upon as many varieties as possible. So this is about financial management. We have left with economics of finance, which we will take it up tomorrow. So today we'll stop at this point. Tomorrow we'll meet at same time, 10 o'clock. I repeat, tomorrow 10 o'clock we'll meet, and tomorrow we'll dedicate ourselves for economics for finance. So take care. We'll see you tomorrow at 10 o'clock. Have a nice day.